Trump, Tesla, turmoil, and all kinds of craziness happening between these two men. Does this affect our investments, and who's the bigger loser of these two? The S&P 500 is 1.5% from lifetime highs. Do we break out and go higher from here, or is this meaning a market that's ripe for a correction? And finally, the earnings reports for the first quarter are almost in, and we have a bunch of winners, but we've also got some wieners. It's Thursday, June 12th. I'm Charles Brown III, Portfolio Manager with CB3 Financial, and this is CB3 Live. We're glad you're with us for a very full docket tonight. So much to cover. Let's start right away with our opening three topics. Tesla, Trump, and turbulence. Should investors be worried? So Tesla has been on a downhill move, you know that, but recently recovered when it seemed like Elon Musk had semi-apologized to Donald Trump. But meanwhile, all of this happens as the market gyrates, just flat out gyrates, and it's extremely frustrating for all of us, I'm sure. The S&P nears record highs. This could be very positive, or could it mean that the market gets up to the highs and says, no, we're not going any further, and then does a correction? We'll get into all of this. And the first quarter earnings wrap up, winners, losers, what's next? We're going to break down which companies look good and which companies did not do so well. So here we are. The world's richest man just picked a very public fight with the world's most powerful leader. Who's going to win that? Well, it actually cost Tesla shareholders $152 billion in a single day. Some of that's corrected back to the upside, but still, it has more effect than just on Tesla. All right. It raises a critical question. Is this temporary turbulence or the beginning of a structural shift that demands portfolio rebalancing because so much is weighing on this Magnificent Seven stock? And in my opinion, this feud will have implications for the entire tech sector because people are realizing now this is more personality driven than a stock. When you used to buy in the old days, a General Mills, a General Motors, it wasn't so much built on a portfolio of different businesses. It was a leadership group. And now it's based on a single person, an Elon Musk, or a Larry Ellison at Oracle, okay? So it's just a different kind of investing environment. So within days of leaving Doge, Elon Musk publicly criticized Trump's signature tax bill, specifically opposing provisions that would eliminate the EV tax credits. But Trump is saying he already knew that that was in there. Musk already knew that was in there. And his response, of course, was to then threaten to revoke Musk's government contracts, following Musk's expressed regret. Tesla stock has shown some signs of rebounding, but certainly not back to where it was. This is the way it looks. That red line is the stock performance of Tesla this year. The green on the circle there is how much of Tesla's revenue comes from automobiles. So they do have energy and batteries and services and even some regulatory credits, which thanks to the US government, that's the slight pie slice there in red. But for the year, at the low point, they were down 29%. And a lot of this is based on the fallout between the two men. So here are the three major investment issues that we need to be thinking about. Tesla made a $2.6 billion gain from regulatory credits. That's that little red slice that I mentioned on the chart right there, and is now threatened by the proposed elimination of EV tax credits. And it's not just about Tesla, it's about the entire EV sector. It's just that Elon Musk has the biggest mouthpiece. There's concentration risk. Tesla has fallen 29%, making it the worst performing large cap, or we're going to call it a mega cap stock, in 2025. The key man risk premium here is what I mentioned earlier. When a company's fate is closely tied to one person's personal and political relationships, traditional valuation models break down. So going forward, Tesla's fundamental business remains strong, and the company still leads in EV technology. And I think it has tremendous long-term potential, but the Musk-Trump feud highlights that betting on Tesla requires accepting both political risk and leadership volatility that many investors, and I would say I am in this group, underestimated. So we have lightened our position in Tesla in the DS program, but I still think that it becomes a satellite holding and not a core holding in that portfolio. The turbulence isn't just about Tesla. It's a reminder that in today's market, political relationships can be as important as quarterly earnings. And that's the new reality of investing in this era of the Trump presidency take two. I don't think this is done by a long shot. It may be done with Tesla, but as you can see from what's happening in the streets of America, this sort of brouhaha is something that Trump does not flinch from at all. And if there is another corporate leader that takes him on, it's going to turn into what you saw here. So as investors, we just need to be aware that the dynamics are changing and that this is something that is going to affect us all right? And this is what we do. This is just what we do in our line of work. So the S&P 500 nears record highs, break down or break out? Well, I'll make the case for both. Obviously, you're going to be thinking about this. You know that we've had a pretty much V-shaped correction off the low since April 2nd, really April 4th. So the S&P has been riding high, reaching new peaks in February. We knew that. All right. Then came Trump's tariff announcement. You can see on the chart to the left, the little red dot there in February. That's the lifetime high. And actually, depending on if you look at the S&P or the NASDAQ, it was a little bit later in the NASDAQ. So the record high of 6144, decent performance for the year, up 2%, but it was up much more than that in February, obviously. So the index plunged just over 10% in a few days, officially entering correction territory. Now, that is never a fun place to be, for sure. However, the S&P did much better than the NASDAQ, which actually crossed into bear market territory at about a 21% fall off. And this was before our last show. And then it's dramatically recovered from there. But if you're a portfolio manager, which of these dips do you want to buy? And which dip keeps going lower? That's the problem that we have as managers. We have to stick with a methodology. And that means taking stops when they're hit and not necessarily rushing back in to buy. So our investment strategy turned into complete capital protection mode in just 2 days. We did the same thing in February 2020 during COVID-1, and we reversed to risk on 27 days later. We've reversed more quickly here, although we're still not in full risk on mode. Even though we're fully invested, we still have some conservative stocks in all three, well, actually in both programs, not in DS. That's always very aggressive. So as we approach these highs, What's the question? Are we on the verge of a decisive breakout, or is the rally setting up for a dramatic breakdown? We believe it's the former, but we're waiting to see which it's going to be, and we'll be prepared for both. By the July show, we'll know what happens here. So for growth-oriented portfolios like CG, we're going to maintain our core exposure, but we're also going to hedge with some defensive positions. And that has caused some underperformance, which you guys know, but your clients, all right? However, we are still protecting to the downside in case more of this tumultuous tantrum stuff happens either with Trump and Musk or with another party. For income-focused strategies, we're looking for very strong cash flows in the companies that we're investing in. We do both of these strategies at CB3, okay? The S&P stands at historic inflection point, strong earnings, AI innovation, all this stuff looks great, and yet the geopolitical risk, not just here at home, but obviously, certainly with Iran and Israel posturing, and of course the Russia and Ukraine situation continues to evolve. Our path has to be the least resistance. Will probably take us higher between 6,300, 6,500. And I still think that's achievable by year end. But we need to settle down and not have as much of the histrionics that we've had in the first part of this year. So the breakout scenario on the left-hand side, about a 60% shot here, I think. QE target, or Q3 target, I should say, of 6,300, year-end target, 6,500. If it were to break down, we're going to have support around the S&P 5,800, major support at 5,400. I don't see us going into a bear market this year. I think there's just too much good out there and innovation, especially if we continue to see more of these trade deals. If the China trade deal really is as good as it is being brought to with Howard Lutnick and President Trump, all right? So earnings, all right? I said that we had some winners and some wieners. So overall, good numbers, 13.4% S&P growth. Expected was 7.8. So that's not quite a double, but that's really good. 78% of the companies beat earnings per share estimates. 27% of the Magnificent Seven had better earnings growth. There's a lot of data here tonight, guys. All right, 90% complete. That's actually a few hours old. We're now about 96% complete on the earnings reports, and the expected growth rate for the second quarter is down. So we're going to talk about this in just a minute, but let's look at the winners. Palantir, Constellation Energy, NRG Energy, NVIDIA, and GE Aerospace. We own 4 of these 5. We don't have Constellation for a couple reasons, but nuclear energy, AI demand, power generation, you can see the things that made these stock winners. And on the left-hand side, see those percentage gains, really strong performance for these stocks, and not all of them in the same sector. So that's good. We spread it out over several sectors, but the 5 wieners, pharmaceutical supply, not good. FMC chemicals, 74% profit drop. So what happens is if you have an earnings estimate and you just totally bomb it, the market will kill you. They did the same for Delta, United Healthcare, which is still getting over the loss of their CEO from a few months ago, and then United Airlines. So 2 of the top 5 worst performers are in the airlines industry because there's just a travel slowdown. So what does this mean going forward? We do expect to see a downward shift from quarter one's blowout earnings, the ones I just showed you, to quarter two. Now, quarter two, obviously we're in right now, but the earnings reports start coming in on July 7. So we always look backwards 1 quarter. I think there's going to be a dramatic deceleration, 5.2 versus quarter one's 13.4, dramatic difference. Estimate cuts, 4% reduction. Management caution, we're seeing in the preliminary estimates from these management companies, don't expect as much. And you can blame this on the fact that there has been so much uncertainty generated by the tariff tantrums. And it just continues. And President Trump seems content to let that continue because he wants to stay on target for his goals, no matter what happens in the stock market, because he believes all of this is temporary. So tech is leading at 8% versus consumer pressure and critical margin theme, I should say, input cost inflation forcing strategic decisions. This inflation is caused by the tariffs. Prices are going higher because prices tend to go higher when there's unexpected changes that companies that are producing the widgets can't control. How do they fight that? They put in an extra pad in cash. They do that by raising prices. And since everyone knows we're in inflationary times, people don't fight it. Well, they may start doing that. All right. U.S. corporate profits as a share of GDP continue to rise. This is a strong positive. All right. They did fall slightly to 13% of GDP. You can see on the far side of that chart, that little line went down. But overall, we're still seeing strong profits. I can't tell you enough how unexpected this is for a lot of people that are thinking, with all of the bad news that is out there, why is this market 1.5% from lifetime highs? And I recognize that. And when those new highs are taken out, we will have probably no hedging in CG at all. But right now, the VIX is still above 20. At least it was today. At least intraday it was. It closed at the 19 handle. All right. Until the VIX gets down to 16, for those of you that don't know the term VIX, it's the volatility index. It's measured by the front month options in the S&P 500. And it's an indication of fear. The VIX is the market's fear indicator. And as long as that's above 16, we have to be prudent in what we're investing in. It doesn't mean we can't be fully invested, but it does mean we need to have some of the conservative sectors. When the market trades below a 16 VIX since 1950, 0 times has it ever gone back up into a bear market. 0 times. So we're looking for that 16 in the VIX. That's what we really want to see. All right, so we have a new software vendor here, and I really like these guys. This is Koifin Technologies. I just signed the deal with them a couple days ago, and here's something I have not learned: how to project this cool data on a small screen. So by the July show, I will have this figured out. But here's the one line that you need to pay attention to. You can see all the other lines that are blurred together. That's the general behavior of the market here in 2025. And that's all the world markets, from the G7 countries to some of the emerging economies. And you can see they're all moving pretty much lockstep, except that top asset. Anybody know what that is? That is gold. And we have gold in both CG and GI for that very reason. Now, anytime gold is performing this strongly, that means there is a significant amount of fear in the market, because they want an inflation hedge and they want a non-correlated hedge to equities because of uncertainty. That's part of the reason why we remain not fully aggressively invested in CG and GI. All right, but there you go. Gold, definitely the #1 performer for the year. This is the longest periods of negative real equity returns. Now you'll see we're third from the top, and then look at the other countries, the European countries at the bottom. So imagine going on for 98 months, all right? 98 months without having positive returns. We've never had a situation even close to that bad in the US. And that's part of the reason why we do have some investments in Europe now in both programs, CG and GI, but we don't have that much because there is uncertainty there as well. We're on the good side of this trade deal situation because they're going to be permanent tariffs and permanent high tariffs if these nations don't come to the table quickly. President Trump said literally just today, get to the table or these trade tariffs are going to be permanent. So we have that going for us. We also have going for us that we don't have a history of a long extended period of real equity negatives. Okay. You guys know this chart. This is just a reminder for you that think maybe things aren't going to turn around. There have only been in the last 100 years 3 secular bear markets. And there they are. One was the Great Depression. One was in the 70s. One we all lived through here from 2007 really to 8 to 9, and then they were rotated around, and then they broke out April 10th, 2013. That was the breakout of the current bull market, and we are still in that bull market. All right, guys. Any questions, type them in the chat box. Good to see you, Nellie. Thanks. Good to see you. Guys, all appreciate you being here tonight. So U.S. policy, we know the drill. Politics, we all hate it, right? I've become really hating it more than ever. Just based on the way these men are behaving. And I guess we need to get our ace artist here, Heidi Steiner, to Photoshop out Elon Musk from this graphic. We didn't do it this week. Portfolio impact. All right. It starts with politics, which leads to policy, and policy has personal impact. It definitely does. And it has portfolio impact. And it's mostly driven around the decisions that this man is making. All right. So if you were thinking that surely Trump is not spending as much as Biden did last year, think again. There's the comparison graph from Trump's own U.S. Treasury Department showing the first 90 days in office and the first 90 days of Biden's last year, and Trump is outspending him. And there's no COVID emergency here. He's saying that he's going to get these high spending dollars back by tariffs because he has the highest tariffs in place since 1909. There's the chart. Look all the way back to 1790. All right. This has been one of the biggest jumps, not the biggest, certainly back in the 1800s and even the late 1800s, 1890, pretty big move there. But this is next to that as far as the velocity of the moves. And the U.S. still has nearly the highest tariff rates in the world. So the bigger the circle means the higher the rates. And just recently, this says 2 days ago, it's more like 16 days ago. This chart's just a little dated here, but the dot sizes are proportional. So I'm showing you this because we are in unprecedented times. And if you're a portfolio manager and we are in unprecedented times, there's no such thing as unprecedented rules to be made in how you manage a portfolio. But certainly when the roads are slippery or there's ice, those of you that are out in the Midwest, in the plain states, know that when there's ice and rain and snow, you slow down. And in portfolio speak, we get a little more conservative just in case there's a big, sharp move to the downside. We're protecting your money to do that. That's just the way it works. So U.S. tariffs on Chinese goods. Look at this erratic path here. Just everything's smoothing along here at a 20% tariff. And then all of a sudden in 2025, it jumps up more than 140 and then rockets back down to 45. It is currently at 45. We will watch to see how long it stays at that level. But the truth is that the U.S. and China desperately need each other. We are by far China's biggest customer. You can add all these other countries up on the left-hand side. They don't even get close to the import volume that the U.S. has. So China needs us. And here's another reason that these countries need us. They have a debt problem. So these are the G7 economies: Canada, France, Germany, Japan, Italy, Britain, and the U.S. Notice that China's not in there because they're not a G7 country. But who has the worst debt situation there? Japan, followed by Italy, followed by Britain, followed by France. We are the 6th of 7 as far as having a debt problem. Now, we have a bad debt problem, a really, really bad debt problem. It's just not as bad as these other European nations that are part of the G7. So if trade gets stopped with these countries because they get belligerent and don't want to negotiate with us, their debt is going to skyrocket because they don't have the dollars coming in to levy taxes on those for the consumers in those countries that are buying the goods from the U.S. So we have that leverage, and that is why Trump is holding on to this, because he believes, and I'm in agreement with him, this is probably a once-in-a-lifetime opportunity. I don't know of any other person that could be in office right now that would have the courage to do what he's doing. Some people will say, and I know some of you listening will say, no, it's just insanity. Perhaps it is, but it was, voted to be insanity about what Abraham Lincoln did, but it saved the nation. So that's why he's doing what he's doing. This is one of the reasons, the G7 debt, that's going to work to our advantage. This is the share of government debt held by central banks. All right, so notice that it rises to a peak. The UK is highest, or higher than everyone but Japan, Italy, Germany, and Canada is the least here. But other than Canada, we are in second place there. I mean, yes, we do have a debt issue as far as what's being held by our own central banks, but these other countries are in worse shape, and that simply reduces their negotiating power. Now, this rare earth topic, I just want to bring this up. I've got several slides on this. You're hearing this constantly in the news. First of all, it's not so rare. What it is concentrated in several countries, and they're not countries that are friendly to us, okay? That's why they're rare. It's not like there's only 6 of them on the planet or 17, all right? There's a bunch of them, but look at the map. Yes, we have some. Greenland has some. Brazil has some. Brazil's quasi-friendly with the U.S., but look at the dark green there. Guess who? China, all right? So China's rare earth production supremacy, 68% of global rare earth production as of 2023, far surpassing the US and Australia, which together combined for 17%. Folks, I don't know how it got to be this way, but somebody was sleeping at the wheel. And I'm going to go back way to Reagan and maybe before that, although rare earth was not talked about much later than George Bush, the senior. But there was just no attention being paid to, hey, we have to get in the game on this. And the negotiations, frankly, with Greenland should have started a lot sooner, but I digress. But realize this is where China has the definite upper card here. Their grip on rare earths, reserves, 52% mining production, all right? The rest of the world is 31%. There's 69%. Refined production, the rest of the world is only 13%. Refined production of rare earth magnets, only 9% in the rest of the world. And then refined production for heavy rare earths. Now, the heavy rare earths, you're going to see, if I can get this pronounced right, lithianides are the light, and then the heavy are the europlum and lutetium rare earths, okay? And all but about 1% of that is produced in China. Now, I don't know how you can really protect against that, because it's not like you can back up the clock and put rare earths down into the soil. That's not going to happen. But buying them up and storing them in the same way that we store crude oil in silos in Oklahoma seems to make sense to me, rather than having to wait on the latest delivery coming off the boat. And it may not be quite that bad, but we don't have the reserves that we need. And I think that is another item that's being brought to the forefront by this tariff war situation. So they hold a near monopoly on these crucial components for electronic vehicle motors and basically critical minerals for telephones, the phones that Apple's making, all the other equipment out there that's high tech. All right. Washington, trying to get some leverage, halted shipments of semiconductor design software. So the semiconductors are made in the Asian countries, but they're using the software that we produce. You see the interconnectivity of everything here? So this tariff war can't go on forever, because every major G7 plus China country needs to have what the other one has to offer, all right? The U.S. and Chinese officials, and you know they were still meeting over there just a few days ago, have agreed on a framework. We're going to see if that will remove China's export restrictions while offering at least a little bit of a sign of a durable resolution, but this challenge is ongoing. I highly recommend that you all become comfortable with the term strategic uncertainty. Strategic uncertainty will ensure the U.S. gets the best trading deals possible. No one values nor implements this strategy better than Donald Trump. You may not like him, you may not agree with him, but I do believe that when this is all said and done, we are going to have better trade agreements and more free trade than at any time since Dwight Eisenhower was in office. That's when this egregious trade imbalance, not Truman, but Eisenhower, which he was the president when I was born, all right, allowed the trade deficits to get out of hand back then, just a few $1 billion a year. And look what it's mushroomed in now. It's crazy. Canada alone, $230 billion trade imbalance between the two countries. I'm going to rest my voice here for a second before we get on the Fed. If you have something you'd like to ask, type it in the chat and I'll get back to you. Is that an SM7V is the question. It is a, I should remember the model number. It's a Shure MV7i. Was recommended this mic. I've had my other mic for 5 years since the beginning of the show. I don't know if I sound better or worse to you guys, but it sounds really good in the headphone. I hope you like it. So, hey, Debbie from South Dakota, how are you? All right. You guys got any questions? Just a reminder, we're going to start breaking out. Josh, my technical guy, is going to start breaking out these segments. So if you don't want to sit through, a whole video again, you're going to be able to see just certain segments of it. And I hope you find that useful. So the Fed, all right, not a whole lot going on here other than Jay Powell's about to get fired. It looks like Scott Bessent, who is now the Treasury Secretary, is soon to be the new chairman of the Federal Reserve in May. That would be 11 months from now when Jay Powell's term expires. There's nearly 100% chance that his term will not be renewed by Donald Trump, based on him being called a numbskull today in the press and other times too. But it looks like only one rate cut this year, maybe in September, but probably not. So this graph showing the retreat of interest rate, but flattening out in 2026. I don't know why it's taken the Fed this long to respond. We are seeing CPI drop. You're going to see that in the inflation section. But I think they just don't know how to deal with these tariffs. And so they're reacting in fear rather than saying, no, this is just the new modus operandi. We're looking at the CPI data. We see that going down, so we're going to drop rates. They're loath to do that. Or it's because Jay Powell wants to just stick it to Donald Trump. I don't know if that's true or not, guys, but it's certainly possible. So all eyes on U.S. inflation, right? So the May number at 0.2 came in as predicted. You can see it there on the chart. Expected 0.2% in May compared to the previous month. So really unchanged. It's not a big deal. It's holding in there. We'd like to see it get a little bit lower, but inflation right now at the consumer level, not a big issue. So for 4 months, economists have predicted that the U.S. inflation rate would reignite in part because of President Trump's trade war. That's again why the Federal Reserve is so reticent to drop rates. All right. And the knockoff effects of his tariffs, or the knock-on, I guess I should say, effects of his tariffs would be on the economy. But for a fourth month in a row, inflation data released by the Trump administration's Bureau of Labor Statistics, confirmed by Bloomberg, came in lower than expected. That's an astounding number. 4 months in a row, and even if it's 0.1%, which is the smallest increment that they'll report in, says something. That means that inflation is not gaining traction and, in fact, is slightly receding at the consumer level and the producer level. So that's the PPI, which was released today. So consumer price index, excluding the often volatile food and energy categories, only increased 0.1 from April, but it was back down in May. And you can see the chart on the left-hand side. The trajectory is in the right direction for the CPI, less food and energy, commodities, less food and energy, and service, less energy, right? Everything's coming down. Maybe not as fast as we like it, but we do like it. So, hey, John, welcome. U.S. has some rare earth materials, but our cost to harvest much higher than China. And I think that's exactly right. We have the ability to create an enormous amount of crude oil and other carbon materials here in this country, and can do so for similar cost to Saudi Arabia, but not the same for rare earth. And I think that's an area that needs to be worked on. Thanks for bringing that out. Permitting to mine here is more intensive than China. That's part of the regulations that Donald Trump is trying to get rid of before he leaves office. A lot of these environmental constituents in this country don't want mining, but we have to become more independent on the rare earth place, and that means we've got to reduce some of these restrictions. So economic indicators, that I look at these every month. I'm bringing these to you. These are not what I'm deciding trades on today, but what I'm looking at sort of in my bullpen for trading ideas down the road this year. So consumers are earning more income, they're saving more money, they're spending less in April. We still have yet to see the May numbers, and that's what the government data is showing. So personal income rose by 0.8%. That's a positive. Last month's reading represented the largest month-over-month increase since May 2021 and far exceeded the consumer consensus estimate of 0.3. All right, that's great. 0.7 versus 0.3, this sizable jump fueled by a 2.8 surge in personal current transfer receipts, money not tied to wages. All right. So the consumer is still very much alive and well, and they are willing to borrow if they need to. But from what we're seeing here, they're not doing a lot of borrowing because their wages are remaining steady or slightly growing. That bodes well for the world's largest economy. That's why we are the world's largest economy. And therefore, every single country in the world wants to sell their goods to us because we are the biggest market. Period. Don't believe anything else you see on the internet. Small business optimism turned up. Obviously, there are more small businesses in America than any other business, large or government spending. Small businesses, if you see them being optimistic, that bodes well for the economy. Debt to GDP, though, likely to rise. I'm really concerned about this federal debt held by the public. So that means the amount of people that are holding treasury bills. All right. The government, and here, that's the big, beautiful bill that President Trump talks about, still has an enormous amount of spending in it, in my opinion, that is unnecessary. Do we need this? Yes. Do we need to sustain the Trump tax relief items that were scheduled to expire this year, that they first went into existence in 2017? Yes, those have to be continued. But the problem is that there's fighting amongst the Republicans because they're not going to get one single vote from the Democrats in the Senate. And that's the challenge here. So this debt issue is continuing to be a challenge for sure. All right, so investment methodology. Just thought I'd show you relative rotation graphs again. I like these a lot. I've shown them over the years. And on the left-hand side, these are the weekly sectors. So I'm always looking at, when I'm looking for stocks to buy, I want to know which sectors are doing well. And on the left-hand side, that's a weekly chart of the sectors and how they're rotating. So the top 5 are there. On the right side, you'll see the top 5 on a daily chart. And again, rather than just buying a sector like XLP, which is the consumer staples, or XLF, which is the financials, I'm looking for the strongest constituencies that are outperforming those sectors, because if that happens, then they're likely to outperform the S&P index, and that's what you pay us to do. All right. So it hasn't worked that way for the founder of the company. So Julius de Campenaar is a good buddy of mine, and he publishes his performance on a system that he uses. Now, this is just his model account. Obviously, he has a lot more invested in this, and he has clients that are trading this. But starting with 100,000 on January 1st, they're down about 5%, and you can see where it breaks apart there. They're maintaining the S&P until April 2nd, and then look at the departure there of the benchmark. All right, this is what he wrote in his latest newsletter. So, due to the positions of consumer staples and utilities. Now, what that means is, just like we did in CG, I had one person say, what are you doing with 5 utility stocks in CG? I said, because everything else is on a sell. All right. And this was obviously early in April. And when the market turned around and came out of it, we started rotating back to the aggressive stocks. But we can't just do that overnight, because when's the next tantrum going to come along? And again, my job is not as much to make money. That's the secondary issue. The first issue is to protect, to the greatest degree possible, the assets which you've entrusted to me. And if you're investing on your own and watching the show and you're not a client, that's fine. But I hope that you take that same mindset. I'm going to go back to camera here. Always, always, always protect your money first. And those of you that have gotten an email from me, there's a quote from Paul Tudor Jones that says, absolutely, the most important thing you do is protect the assets. And then making money will come in secondary. And certainly we all want to make money, but you can't make money if you don't have assets there to trade, right? So that's why saving is so important, saving these losses. So that is what has caused the underperformance. Julius goes on to say, now we're just about 6% since the first of the year down. Okay. Is this ideal? Well, of course not. For those of you that are clients and heard my podcast, I hope you did. It was the first one that I ever did just for clients only. I sent you a special URL that only you clients can go to. It's not ideal, but the reality is that trend following systems like I have, like Julius has, have to play out. The worst thing you can do is abandon a strategy just because it's going against you for a few months. He will stay the course. I will stay the course, maintain the discipline, and continue to track this portfolio based on our established metrics. And we do the same thing with you. In the performance report that I gave you, we went back a year and a half and I showed you the strong performance periods, just like we had in 2016 and 2020. All that data is available if you want to see it. It'll be interesting to see how long it takes for our strategy, meaning his, but our strategy, meaning CB3's, to get back on top, outperforming the S&P again. Practice is key in these situations. So I'm excited to tell you we have a brand new segment for you tonight. All right. Money in motion. Money in motion. Money is always moving in various places in the world, in every place in the world. And we're going to cover 3 key financial matters: ways to make money, ways to save money, and ways to preserve money. All right. Ways to make money investing in stocks and fixed income is what we'll start with tonight. So again, this is Koifin. This is my brand new vendor, and I'm sorry, but I can take you to the important parts here. All right. When I am looking for a really strong growth stock, I'm looking for, believe it or not, a stock that has somewhat violent behavior. So look carefully at the screen. What you're focusing on is not the purple, orange, and yellow lines. Those are just the indices, the technology sector, the S&P 500, and the NASDAQ. This blue line, the faint blue line, is the performance of this quantum computing company. Now, I look at that and go, this is crazy to want to be investing in, but is there a buy point when there's a retreat? So that's a 5-year look back. So now I'm looking at just 3 years, and you can see it did hardly anything for 2 years and then started to wake up again because it had some emerging technologies, certainly tied to AI. It made a huge move up, came back to manage essentially a break even with the S&P and the NASDAQ. And then it shot up again. So I'm still looking for a pullback. All right. Well, here is just the current quarter to date. And now you can see that it's rocketed up again and has not yet pulled back. So now I take this to my risk management software, which is TradingView, and I can plug it in here, and you can see the red bar. We're on a buy once we exceed that level in late April. And then we have that pullback, and that's where we went in to buy it. So what is my point of showing you this? There are many different ways to invest, and I'm not saying my way is the best, but my goal with this segment, Money in Motion, over the next many years is basically to democratize what I've learned in 32 years so that you can use it yourself. And yes, that means you can use everything that I teach you and do this for yourself if you want to. It's okay with me. All right. I want to do my best in this segment, which will close every show, to show you what I've learned about making money, saving money, and preserving money. All right. All right. So that's what we're doing. Now let's go back to the show. Let's look at fixed income. So I just showed you a growth stock that would be appropriate for DS or CG. But if I'm looking for income in GI, I'm going to be looking first at the global yields around the world. Why? Because I want to know what I need to expect in a conservative investment. So this investment we're talking about is exactly the opposite of what I showed you the first time at Quantum. All right, so I start first looking at the different countries. All right, this is not quite G7, but close. US, Germany, United Kingdom, Spain, Italy. All right, China's in there. And then different durations, 1 year, 3 years, 5 years. So notice that the difference between a 1-year return in the US, 4.080, versus 10-year, 4.4, is not dramatically different. There was a time when this was like 300 basis points apart. So I have to have an inclination as to what the reasonable rate of return is in the way of yields and what I can expect to be able to put into a portfolio. And again, I know there's a lot of squiggly lines here, but all you have to pay attention to are the colored ones. And I promise for the next episode, I will have this figured out so I can project this better. But again, I just started with Koifin. They're fantastic. Their data is just fantastic. Better than Bloomberg, in my opinion, and way cheaper. But at any rate, what you're seeing here are different rates compared to the dollar differential. So you have to take into account when you're looking at interest rates around the world, where's the yen trading, where's the euro trading, where's the Swiss franc trading, et cetera. And this allows me to look in multiple places just to get a sense of what I should be able to expect in the way of non-correlated returns. So we already have some treasury instruments in GI. I'm looking for something different than that that's not correlated to US Treasuries. So again, I can pull this chart, I can pull this data on this Schwab high yield ETF. All right. And I'm going to research this. I'm going to look at the returns on it. I'm going to look at the drawdown on it. You can see the gray areas where it pulled back. And in some ways, this will respond more closely to an equity than it will an interest rate. But I am looking at a return on this, an interest rate return over 7%. Now, if you remember the earlier part of the chart, there was nothing even close to 7%. So what I can do is see with the treasuries, which are going to produce probably around 7%, I can take a little bit of chance here. Now, I know you think GI is more conservative. It is, but I still need to take reasonable concentrated risks in the fixed income area to get you that higher yield, because many of you that are in GI are expecting income from this. Okay. So that's what we're doing with this kind of investment. We then put that on the chart. We look for timing. You can see it's right up next to the breakout area. It actually ticked up there, and I bought this just earlier this week for GI. That's the anatomy of how you make money with stocks. And there are many ways to do this. And again, over the next several years, I'm going to continue to have this segment and show you that. So the second thing that's important for me to convey to you, again, I'm trying to democratize, meaning pass on my knowledge to all of you so that you can use this. And that's how to understand that poor spending habits get you in trouble. Here are 7 ways for saving money. All right. Don't spend money you don't have. That's not even on there, but that's a simple one, right? But look at this budget rule. So 50% of what your income is should be spent on needs like food, housing, insurance, etc. Only 30% on wants. Do not reverse those. And here's the most important one, 20% in savings. And I would argue that you want to get to the point where that 20% goes to the far left, and that's the first thing you do: funding an emergency fund, investments, retirement, etc. Number 2, the 1% rule for impulse buying. I love this. If the item is over 1% of your annual gross income, wait 3 days. That's a simple thing. It curbs impulse buying. Wait 3 days. If that item you're looking at buying, if you make $100,000 a year and this item costs more than $1,000, not $5,000, $1,000, just wait 3 days and make sure it's something you really want to do, or that it's returnable. Rule of 72s, I've talked about this for years. 72 divided by the interest rates is the years it takes for money to double. So in very simple terms, an 8% return, 72 divided by 8 equals 9 years it takes for money to double. Realize that and teach your children that, because it works the same for debt. It's just that you're probably not talking about a credit card rate at 7 or 8%. 72 divided by 18% means the debt doubles every 4 years if it just sits there on a credit card. Don't do that. All right. That's why this segment is so important. Money is always in motion, and it can be in motion going out of your pocket even faster than it goes into it. 401k match. If you've been listening to me for the last 20 years, some of you know I've said that many times. You should always, if you're still working, you got to have that match. 3 times your emergency fund rule. If you need $10,000 a month to live on, you need to have $30,000 in an emergency fund, because you don't know when an emergency surgery might happen. We just had one of those announced to us, and we're praying for the person, and good thing there's an emergency fund there, because that came out of nowhere. Now, I understand medical insurance kicks in, but there are co-payments and support that's needed after the emergency, after the surgery, I should say. All right. And then, of course, the rule of automation. Defaults are powerful because people are lazy. So if you want to be careful about this, if you are going to get subscriptions and going to keep getting subscriptions, don't, and I said this on my podcast earlier this week, I want to make sure, in case you're not listening to my podcast yet, you need to be. All right. If you're going to subscribe to something and they give you a choice of monthly or annually, don't do the annual, do the monthly. and didn't do the second month, maybe even the third month, it's okay to overpay for 3 months until you're sure you want it, and then and only then subscribe annually. That's what I'm recommending. And then finally, if you put an item in your household, take one out. You don't need stuff just, and this is a great way to not have to clutter up when you need to move, either at the retirement home or wherever you're going. Something comes in, take something out, all right? Give it away. It's likely that thing you're taking out you haven't used for years, okay? That makes sense? All right, money in motion, money in motion. Now ways to preserve money. I'll take questions from listeners from time to time. Please send me your questions, cb3@cb3.com. Here's one from a listener. We said, how do I handle my mother's estate? Where do I start with the legal work, or do I hire a CPA? First off, I am not a CPA and I'm not an attorney. I'm never going to give you advice in that area. But what I can tell you is first determine if the estate must go through probate. If your mother, and that's answering this question, had a living trust and transferred her assets into it, you might be able to avoid probate. That would be fantastic. If not, you'll need to file the will with the probate court and notify creditors and agencies like Social Security. So opening an estate bank account is essential. I can't stress that enough. You need to open a bank account. If you're going to have a trust, you can't just create it on paper. You've got to have a bank account associated with that. And likely you'll be retitling your investment accounts too. Again, I am an investment advisor, but I'm not a tax advisor and I'm not an attorney. But just pay attention to what I'm saying here. If you're in this situation or you know someone that is, at least be aware of this very basic thing. Are you going to have to go through probate? Preferably you do not go through probate, or it's a very simple probate because all the assets have been placed in trust. You stand before a judge and say, Your Honor, there are no untrust or non-trust assets. They're all in trust. The judge will hit the gavel and say, next. And that's what you want to hear. All right. Questions on that, shoot me an email, cb3@cb3.com. I am excited to tell you about our next interview. Mike Malicia will begin talking to me about 2 weeks from tonight, I think. And we're going to talk about his career, what it's like to be an asset manager in New York, what it was like to be at Bear Stearns. Obviously, now he wasn't there when they crashed, but I don't know. We'll see what he has to say about that. But certainly that collapse influenced him, all right, a lot. All right. But he launched his own investment company. He's a great guy. I've enjoyed his writings and we've become buddies. So a asset manager in Chicago is going to interview an asset manager in New York. That will not be on the show. That'll be one of our special episodes, and we hope that you'll tune into that. You'll receive an email. You need to be on our list so that you get notified when these special episodes come out, all right? But I hope you'll enjoy that. So that's it for tonight. If you are new to the program, be sure to subscribe to our show. Click the little bell so you get updated. Watch for me on Facebook, X, and LinkedIn. I tweet every single day. And of course, the podcasts are coming up on 1 year now. I'm doing an update every week, sometimes twice a week. Hope you guys are seeing that on Spotify, on Apple, on YouTube, Amazon, or wherever you get your podcasts. Definitely follow me there. Clients, I do have a reserved channel just for you on my podcast, and you should be getting emails 4 times a year now. The next one will be July. So every January, April, July, and October for client performance updates. All right. To summarize, as I do every single time, for we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. Guys, I really hope that this is helpful to you. I especially hope that the money in motion, MIM, we're calling it, is going to be useful. I've decided that democratizing 32 years of experience is in your best interest. And if it's in your best interest, then it's in my best interest. And that's what we're going to do. Let me know what topics will interest you. I think everything's encompassed with making money, saving money, and then preserving money. So anything that you've got in that area, I'll get it on the agenda. We're only doing 12 shows a year, but I may do a special episode just for that, and it'll appear on the YouTube channel as well. Hope you guys have a fantastic July 4th. It is 249 years that this country has been around. Next year is the big one, 250 years. What an incredible celebration. I'm proud to be an American. I love it here. Hope you guys do as well. Thank you so much for listening. God bless you all, and I will see you next month.